The legendary big Canadian banks are making headlines recently as regulators have lifted restrictions put in place during the COVID-19 pandemic. So the banks are now able to raise dividends and resume share buybacks once again. So this is good news, of course, for stock prices, as investors are assuming that dividend increases are on the way, along with potential share buybacks, right? Both of which tend to increase share prices. So the question for us really is, what's the best way to invest in the big six Canadian banks? Gone are the days where you need to invest in each bank individually, as we have a bunch of ETFs, a bunch of funds out there that automatically give you exposure to all the banks by owning one fund. So which fund is the best? There are so many choices out there, right, guys? Well, that's not the question you should be asking, because in my opinion, the best when it comes to investing doesn't exist. Sure, you can measure which fund is the best using historical data like total returns of the last 5 years or 10 years, but past performance does not dictate future returns. Never forget that. So for me, the best doesn't really exist. Which is best for you, however, should be the question that we ask ourselves instead. So in this video, guys, I want to review 5 options. All 5 funds will hold the big 6 Canadian banks, but have different strategies and are tailored to different types of investors. So let's go over all 5 options together, and then I'll give you my opinion on each one and for which investor they're really designed for, so you can make the decision for yourself on which one is best suited for you. All right, guys, first fund we're going to look at is ZEB, the BMO Equal Weight Banks Index ETF. So the name says it all. It basically has the big 6 banks. If we scroll down, we'll see that the annual distribution yield is about just a little over 3%, which is no surprise. This is basically the average of the 6 banks right now. Very low management fee. I mean, this is really your most basic option, guys, of only 0.25% or 0.28 is the MER. So really huge fund over here. We're talking over 2 billion in assets. So obviously this is a very popular choice for most Canadians. And if we just click on holdings to see what's in it, there should be no surprise. It's the big 6 Canadian banks equally weighted, which means there's pretty much, it could be a little bit different, but they're pretty much very close in terms of percentage here. So this is the first option here. Very basic option. Very nice, consistent monthly distributions, which is also nice. Second option, second fund I want to talk about, also from BMO, is ZWB. So this is the BMO Covered Call Canadian Banks ETF. So it's basically exactly like the one we just saw, except they write covered calls on it. So obviously covered calls, right? You're going to have more yield. So the yield is a little over 5.5 here. Higher management fee, of course, because covered calls takes a little bit extra work. This is a little bit more actively managed, so it's 0.65 instead of 0.25. And the MER is 0.72. So yeah, if we look at the holdings, it should be no surprise. You have basically the big 6 Canadian banks. They actually have the ZEB ETF within this fund. So this portion they don't touch, but then they have the portion here of the individual stocks, so they could write covered calls on them. And you could actually see the covered calls yourself here if you're curious. So monthly distributions as well. Which is really cool, very consistent. And so you're looking at a nice yield boost of 5.5 instead, thanks to those covered calls. But keep in mind, there's no leverage here. So both of these options, ZEB, ZWB, no leverage. A third option I want to discuss with you is called the Hamilton Canadian Bank Mean Reversion Index ETF. So the stock symbol is HCA. The current yield is about 4%. And a smarter way to invest in Canadian banks. So what does the mean reversion mean here? Well, on the website, you have all the information, and it basically it says what the mean reversion is right here. So mean reversion is one of the most popular themes in Canadian bank investing, given the individual Canadian banks have tended to perform similarly over time. So what they do is they take advantage of these tendencies. So they rebalance the portfolio quarterly. So they invest 80% of the portfolio in 3 banks which have recently underperformed, and 20% in the 3 banks which have outperformed. So basically, they're trying to determine which banks are undervalued, and they invest the majority of the fund in there, opposed to the equal weighted, which is just, we'll invest equally weighted in each bank. So pretty cool. And it turns out that this strategy, the mean reversion strategy, over time, if we scroll down, here it is, has actually outperformed. So here's the graph since 1990, and you could see that the mean reversion strategy has a little bit higher return over time than the, just getting them equal weighted. So this is a really cool option as well. I would consider it a basic option. There's no covered calls. There's no a leverage as well. So this is really a very similar option to ZEB. The only difference is the mean inversion. And if you actually look at the before we look at that, I just want to point out that the management fee is 0.45, so it's a little bit higher than ZEB, right, at 0.25, slightly higher. Big fund as well, 411 million. And if you look at the holdings, you can actually see the mean, the reversion strategy here. So most of the fund is with these 3 banks, which they feel has underperformed, or they've underperformed the other 3 banks. So the bulk of it is in TD, Bank of Nova Scotia, and Royal Bank, where only 20% approximately, or a smaller portion, is in the 3 banks they feel have done really, really well lately, CIBC, National Bank, and BMO. So pretty cool fund. So I would consider this a basic option with a twist. The next fund I want to talk about is also from Hamilton ETFs. It's the Hamilton Enhanced Canadian Bank ETF. So the stock symbol is HCAL. The yield is 4.94%. So basically, what this fund does, guys, is it has the exact same thing. It actually holds HCA, but it adds 25% leverage. So that's basically all it is. It's HCA plus 25% leverage, and that 25% leverage helps to enhance not only your growth, but it also enhances the income. As you can see, 4.94 versus 4.01. Keep in mind, these could be a little bit outdated. And if you scroll down and we look at the what it holds, here it is. It's basically HCA, that's what it holds, but the weight is 125%, right? The leverage. Yeah, the yield, like we saw, is just under 5%. It's a monthly distribution, just like HCA. By the way, HCA was monthly. I forgot to mention that. And the management fee is a little bit higher, 0.65. The MER is probably somewhere around 0.80 because of that leverage, 0.75, something like that. And it turns out, guys, that this ETF, HCAL, so HCA with 25% leverage, is the top performing Canadian bank ETF out there. So it's a really, really cool indicator that really shows that this leverage, the 25% leverage, really helps to boost your returns, right? So I can't think of anything better to put leverage on than something conservative like the big 6 Canadian banks. So another really cool option here, HCAL, which is basically, once again, HCA with 25% leverage. The last option I want to take a look at is the Brompton Split Bank Corporation. So this is a split fund, guys. And as we know, split funds have Class A shares, preferred shares, but the only really interesting thing is always the Class A shares, in my opinion. So the yield, of course, this is a split fund, so it does covered calls and leverage. So it's gonna have the highest yield out of all options for sure. So the current distribution yield is about 7.51%. So that's the dividend yield. The management fee is very decent at 0.55. The unit NAV, so keep in mind, what is the unit NAV? It's the NAV of the Class A shares, 1657, plus the NAV of the preferred shares, which if we just click on this is always about $10. So you combine them and the unit NAV is the unit NAV, the combination. So as long as this number stays above $15, the dividends will be paid out for the Class A shares. So really, really high income option here. If we look at the portfolio or what this fund has, very interesting. So obviously, no surprise, you're going to have the big 6 Canadian banks, but there's also, they throw in a little twist here. They 9% of this fund, or 9.1%, is the Brompton North American Financials Dividend ETF. So they added a little exposure to this ETF here, which is also managed by Brompton. And if we actually look at what this ETF holds, this is an active, also a covered call ETF, by the way. So if you look at the portfolio, you'll see that 80% of it is United States in the US and 20% in Canada. So there's all North American, more specifically, or very heavy on the US financial companies. So Goldman Sachs, Bank of America, Morgan Stanley. And it's not just banks, it's anything to do with financial. So you actually have the NASDAQ, the S&P, Blackstone, of course, Royal Bank of Canada, National Bank is there, BlackRock, Citigroup, Visa. So a lot of cool financial companies as well. So this, although it makes a small portion of it, it just throws in a little twist, a little bit more diversification, which I always think is a good thing. So this is the fifth and final option that I wanted to review for you guys. So which one is the big winner? Let's review them together and compare them to find out. So let's summarize each fund, guys, and for which investor each is really designed for. So ZEB or ZEB is really the most basic option in my opinion. It's equal weighted. You have all 6 banks in there. This is really for a moderate growth and income investor, or aka a dividend growth investor. This is the most basic option. There's no covered calls, there's no leverage, and it's an equal weighted fund. And it has a very low management fee like we just saw. HCA is also another basic option, but with a twist in my opinion, because of that mean reversion strategy, which I think is pretty cool. Like we saw on their website, it beats the equal weighted by a little bit in the last 5 years or 10 years, whatever it was. So this also is a good basic option with a twist and designed for moderate, regular dividend growth investors. Then you have ZWB from BMO, which is your basic income focused option, right? So there's covered calls with this fund. You have a little bit more yield than ZEB, of course, because of those covered calls, but this fund has no leverage. So this is really for a moderate income focused investor. And then you have HCAL from Hamilton ETFs. This is really designed for maximum dividend growth, right? So it's basically the HCA fund plus 25% leverage. That's what HCAL is. So this is really for bullish dividend growth investors. If you really have faith in the 6 banks long term and you want to try to maximize growth and dividend growth, HCAL is a pretty cool option because of that leverage. And I also like the fact that they have used the mean inversion as well. So mean inversion plus 25% leverage, which is very modest. And then last but not least, you have SBC. This is really for maximum income. So there's covered calls and there's a 100% leverage effect, right? Because it's a split fund, that's how they work. So it's not a borrowed money technically. It's the leverage here, it's a leverage effect because of the structure of the split fund. So this is really for bullish income focused investors. So if you're an income focused investor and you really want to maximize your income, you're bullish on the 6 banks, this is a good option for you. Now, keep in mind, there's other choices out there for income-focused investors like myself. There's actually 2 other split funds out there besides SBC. So you have BK from Quadravest. That's a stock symbol, BK. Which, unlike Brompton, has a more complicated dividend policy. So the monthly dividend changes every month and it's based on the fund's stock price, and the dividend is set at 10% of the fund's market price. So essentially, it's the same dividend policy as 2 other funds that they manage, both of which I own, Inc.UN and DS, which is the Dividend Select 15 fund. So BK does have higher yield than SBC right now because they always target 10%. It resets every month. But keep in mind that the yield will follow or will change based on whatever the stock price does, right? So your dividend payouts will increase or your yield will increase when the share price keeps going up, but it will decrease when the share price goes down. So a little bit harder to track, a little bit more annoying. But still another split option for you income-focused investors out there. And a second option is the Premium Income Corporation. The stock symbol is PIC.A. From Strathbridge. So this is a smaller split fund manager in Canada. And in my opinion, PIC.A or the Premium Income Corporation is the only fund worth considering from this company. It's the only good one that they have in my opinion. So this split fund actually has a higher yield right now than both SBC and BK at just under 11%. However, the distributions are not monthly, they're quarterly. And another thing to consider, and I confirmed this a long time ago with them because I chatted them about this, unlike BK and SBC, there is no $15 unit NAV threshold rule for this split fund. So we all know that split funds need to, normally need to have a unit NAV of $15 or more for the dividends to be paid out on the Class A shares, but no such rule exists for this split fund. So since there's no set policy, the dividend payout on the Class A shares, the manager really decides what the quarterly dividend will be. So if you look at what happened in 2020, if you look at the whole history of Pick.A, you will see that during 2020, during the COVID-19, right, during the volatility, they had a few dividends which were cut in half from their normal payouts that they had, but they have since returned to normal, back to normal, which is about a little over 20 cents a quarter or 81 cents annually. So which one do you choose? So although you need to make the decision for yourself, guys, I could give you my opinion on which funds I prefer. So let's start with the high income option or the income focused option. So as most of you have already guessed, and it's the one that I hold personally in my account, my choice as a pure income option would be SBC. I love the consistency and also the fact that they did not miss any dividends during 2020. So the unit NAV of this split fund never went under $15 during the whole crash of 2020. So that says a lot, right? A very, very strong unit NAV. I also like the fact that Brompton added that extra ETF, that North American Financials ETF in the fund. So I feel it complements the six banks perfectly. It adds a little diversification because most of that fund is from the US, right? It's the US financials. So even though it's only 9%, right? The most of 91% of the fund is the big six Canadian banks. There's a little bit of diversification in there. I always like that. And yes, BK, Pick.A can also be good options, but personally I prefer SBC due to the fact that it's consistent monthly income at $1.20 annually. But if you really want maximum income, you don't care about quarterly distributions, you don't care if they're quarterly versus monthly, then Pick.A could be a great option for you as well. Now, if I was more of a dividend growth investor where I want to capture all the growth and the growing dividends of the six banks, so basically you don't want any covered calls, my top choice would definitely be HCAL from Hamilton ETF. So it wasn't a surprise to me that this ETF was a top performing bank ETF overall, like we saw on their website. So congratulations to my friend Rob Wessel and the Hamilton ETFs crew, who I recently interviewed, by the way, to talk about another one of their funds, HDIV. I really love that mean reversion strategy, and I also like the added 25% leverage. That's where you're getting, that's why it outperformed the other ETFs. It's really because of that leverage. So it just maximizes your growth. So no covered calls with this one. So you're not sacrificing any growth whatsoever for more income. So this is the option I would choose if you don't want to sacrifice any organic growth or dividend growth, and you're very bullish on the big banks. So I rest my case, guys. It's really up to you to make the decision. You could also mix and match. You could do whatever you want. You could even invest in the individual bank stocks as well if you're obsessed and hate management fees and you want to avoid them. So to each their own. It's a free country. Thanks for watching, guys. I really appreciate it. Make sure you hit that like button. It's free for you. It takes 2 seconds and it helps the channel grow. So I would really appreciate it. Also, make sure that if you like this type of content on stocks, on high income stocks, especially high income funds in Canada and the US, make sure you subscribe to my channel, not to miss out on my future content. We have a website. Make sure you check it out, guys. PassiveIncomeInvesting.ca. That's where you can access a bunch of free tools, free links. You could download my portfolio. It's also where you could access my digital product that I sell, the ultimate DIY investing package. I'm on version 3 right now. So this is basically a reference tool, a companion tool to help you guys build your own portfolio, to invest on your own according to your investing needs. So it's not just for income investors. I got 14 sample portfolios in there, some for half of them for Canadians, half of them for Americans, or for people who invest on the US stock market. So this product is not just for Canadians, guys. So you have 14 sample portfolios total. You have some for income, you have some for growth, you have one for dividend growth, You have one for low income, low risk income, aggressive income. So there's all kinds of sample portfolios, as well as lists of some top ETFs and closed end funds out there. So make sure to pick it up, as it comes with lifetime updates. So you only need to buy it once to get the next versions for free. Also on my website, I offer a one-on-one consultation service, which is basically a Zoom call with me personally, where you could ask me a billion questions. I could look at your portfolio. I could help you build a new portfolio, transition your portfolio to an income focused one. That's usually the reason why people book the consultation. So whatever your needs and questions are, I'll do my best to help you. Yes, the appointments sell out very, very quickly. I'm always very surprised by this. So make sure you keep an eye on the homepage, where there's a message there. So I'll let you guys know when the December calendar opens up. It will happen in about mid-December for the December and rest of December and January appointments. So speaking of notification, make sure you join our Facebook group, which keeps growing every single day. So we're at almost 6,000 members now. So make sure you join Facebook, because whenever my appointments open up, that's where I make the announcements. Also, we're on Instagram, so make sure you follow us there if you use that social media. And of course, as usual, guys, the mission of this channel, my mission, is to help everyday, normal, working, regular people invest on their own, so they could build their own stream of passive income and enhance their quality of life. And of course, one day become financially free and financially independent like us. There's no better thing. So with that, take care, guys. Continue to stay safe, and see you next time.